Bubbles, fads, and scandals. This is a really fun chapter in the book. I could spend a lot of time talking about this by itself, but let's talk about bubbles. I call them financial hurricanes. One of the articles I wrote, and Kristen bravely allowed the article to go into the magazine, fourth quarter 2008, I wrote a piece that said, yes, these financial hurricanes do occur, but there's some good news. Throughout history, the following year, the markets go up. Well, if you remember where our heads were all at, December of 2008, people thought we were mad. What are you saying? Next year, the markets are going to go up? We're going into depression. Well, it did go down a bit more, but if you all remember, in 2009, the markets did go up, and so did 2010. But the point being this, bubbles occur for these reasons. A combination of over-leverage and illiquidity, sound familiar? Wall Street innovations that went awry, does that sound familiar? Investments responded negatively to failed government actions and over-regulation, another theme that we read a lot about. Also, military conflicts, certainly things that kick in very quickly, very suddenly. Simply put, the names and places change, but the game is still the same. I think it's important for us to remember, and I can't emphasize this enough, if you were to study any of my other work, 2006 and 2007 was a textbook bubble, and it goes back to the theme of why financial history is important. Why did Wall Street miss this? Why did these legacy firms blow up? I can't believe they don't have room on their payroll to have a historian that can at least get them. But for some reason, we buy into it's different this time. And I just don't believe that to be the case. Okay, let's bring it all together. I love this because here was a model portfolio in 1929, and look at the amount of preferred stocks it had in it. My goodness. Oh, and by the way, what do you think $50,000 was worth in 1929? Imagine that. Okay, today's markets. This is one of the longest bull markets we've had. You can see where we go back and look at it in time. It is hard to stretch what length of time is. Notice that I didn't include the 87 crash. Generally, the trends were still up, but now we've entered that time frame. That's historical. Okay, post-crisis markets. A lot of people said, geez, the market's really different than before. It's not true. This stock market is acting the same way it did in post-1929, 1932 time frame. So you have the shock of the market, but many people seem to have this belief, and I'm shocked when I talk to people who actually were alive then, that forget that the stock market in the 1930s, if you had money, you made a lot of money 1934, 1935, 1936, look at that. The Dow went up 371%. What did we do 2009 to 2016? Had a nice, powerful run. Again, putting history in the driver's seat, you could have made some serious money. Okay, this is one of those indicators I was talking about. This is the advanced decline line of the New York Stock Exchange. We have a very powerful market right now. This is, and by the way, this is the S&P 500. We all know what it's been looking like, but keep an eye on this. This, to me, is what's underneath the surface. Look at the advanced decline line. Look at the volume levels. These are things that several generations ago, not too far from where we stand now, people used to monitor. And by the way, it's free data. You can track it yourself. But what also happened in the 30s? Well, we had near zero interest rates. Same thing we had now. So everybody thought, when Ben Bernanke said that he had studied the Great Depression in detail, very clearly he did, because he did the exact same thing. Bring rates to zero, make money free. What I have to give the Fed credit on, and I'm so glad to see it, I was really scared about what was going to happen as they were coming off zero, because it didn't go well in the late 30s. When they started raising interest rates, the markets had a tough time with it. It invoked what we called the Roosevelt recession. But they're doing it well right now. This very gradual rate increase is a good thing, in my opinion. And certainly the markets like it. What happened with bonds? Little trivia question for you. Bonds, corporate bonds, by the way, what I'm talking about, actually recovered in price everything they lost in 1929 within 19 months in the 1930s. The stock market took 18 years. Think about that. So to say everything was down and nothing recovered is simply not true. So here's 1929 to 1937, and then obviously bonds did very, very well through this time as going forward. Going forward, looking at real estate today, this is our index. By the way, many people say, well, how's your index different than Case-Shiller? Well, Case-Shiller, by the way, we talked about timely data. Case-Shiller's data is 60 days old. By the time it's reported, it's what happened 60 days ago. Do any of us care what the stock market did 60 days ago or the bond market? Our index is basically timely, and it looks at new housing data, not necessarily existing homes. It's a reasonable sample size, but this is where it gets interesting. So we have had housing recover. By the way, this is back to the last 4 major collapses in the housing market. I know some of these don't look like they're very big drops, but little drops in housing can resonate very well. But this is the concern. So the time it takes to close on a house is back to 3 months. This is the volume level. We're in once bitten, twice shy range again. People are not rushing out to buy houses the way they used to. They're nervous, and I think it's what I said before about the millennials. They're nervous about home ownership. It just is not a fascination to them. But it does beg the question, what's going to happen when mortgage rates return to normal? Now, how many of you here remember buying a house in the 70s, double-digit mortgages? Any hands? Anybody remember? And sir, I bet you thought you had a bargain, didn't you?
I caught it at a low.
You caught it at
Yeah, I put a lot down, so I got 8.5%.
Yeah, 8.5%. Yeah, that was a steal. Yeah, I bet you were probably. So imagine if we told everybody today we're going to start buying mortgage houses again with 8.5% mortgages. The realtors, oh no, we can't do that. It does raise the question though that if we or when we do have mortgages basically revert to the mean, which in the way I see it is going to be about 6.5%, what will happen to housing? So that is a concern that we have to realize, that the low rates have not generated those buys that we've been looking for, or the buying pressure, and could it actually get worse if we go up from there? Okay, going forward, all this talk of inflation, you hear about it constantly, folks. I'm calling to follow the Milton Friedman view of inflation. It's too much money chasing too few goods and services. Well, one of the base things to look at are raw commodity prices, and as you can see, commodities are basically still heading south. Now, yes, I know oil has bounced back a little bit, but when you look at base commodity prices, they're still rather low. I would expect this to take off if we're going to talk about the Fed getting nervous, so I think that's one of the reasons the Fed is where they are right now. Okay, I want to come back to this. I'm wrapping it up here. Again, what can you do with this data, this wonderful data about time and all the rest of it? Well, let's look at this. This is since 1970. This is common stocks, preferred corporate bonds. Those are the averages, but this is really what I want you to pay attention to. The percentage of time there are up years to down years. I know you've all heard of beta and alpha and all these other statistics, but let's just talk about the amount of time that things are down. Well, stocks are down about 22% of the time historically. Preferred stocks are about 25 and corporate bonds 16. Since 2000, the number went to 30 on common stocks, 20 and 13. There was some movement in the statistic, but what I want you to remember, and what I think it's important for all of us to ask while the market is at these highs, are you really prepared to do buy and hold all over again? Do you believe in that? And I know Wall Street wants to promote that, the robo-advisors want to promote it, but I do think while the market is hitting a new high, you need to decide right now, are you prepared to do that again? Or accept the fact that we are going to have bear markets. Let's hope that we never again see a 50% correction. But as you're going to see here, bear markets do happen historically, 28% of the time, average decline, 29%. Do you want to go through a 29% correction? I will tell you, I ran the numbers. You cannot diversify yourself out of a bear market. I know we all get those pretty pie charts from the brokerage houses. I'll tell you what, go pull out your statistics textbook and find out what happens. The standard deviations all collapse at the same time. Everything goes to 1. There's no way to escape it. There's no way. The correlations tighten up. So this idea that you're going to go into the Brazilian stock market to hide from an American stock correction, or you're going to go, I know that this sounds logical, but ask them to actually show you the research, and the research is at best spotty. But I am concerned about this. We keep repeating the same mistakes. Why does Wall Street have a blind spot on studying history? It's a good question to ask your advisors. It's a good question to ask your accountants. The fact you sat on this lunch to listen to me today says there are many of us here who do think it's important. But just be aware that you might have to be the overseer with your advisor to point out these things to them. Don't expect them to have the answers. Also, a lot of people ask about bonds, why bonds are doing so well. I mean, there was all this talk of the imminent collapse of the bond market as rates were going up. I'll give you an easy one. Baby boomers are retiring. Standard thing that gets asked, they need income when they retire. They don't want to depend on their housing. They don't want to pull equity out of their homes. They don't want to depend on their stock portfolio. They're not selling their bonds. They need the income, and it's also one of the reasons why I think preferred stocks are so popular. Same reason. Then I just am cynical every time I hear something's new on Wall Street. Folks, I was tinkering around with algorithms back in the 80s. When I worked in Chicago, they called me a propeller head. That's what they called the quants. I was playing around with these algorithms. I was playing around with that. I will tell you, there's not a lot you could do with it. The robo-investing today is not that much different than what was being tinkered with during the '87 crash with portfolio insurance and the computerized trading that Value Line has had on their subscription services for 30 years. I'm just simply saying, if you were asking the people who are promoting these computerized strategies, ask them this one question: at what point will these programs raise cash? The answer: never. They just reallocate the whole way down. So again, if you believe that you can diversify yourself out of a bear market, say, Ken, you're a nice guy, but I don't agree with you. But if you believe that one of the best ways of doing this is to either raise cash or to hedge, if you are capable of doing that, don't trust these computer models to do it for you. And the last but not least, anybody here remember Twister? Who remembers Twister? Okay. Don't we all find ourselves that way? We start the year, this is what I'm going to do with my money. Oh, Jim Cramer talked about that, so I'm going to go over here. Oh, Bloomberg's guy from Britain talked about this. Oh, I just heard an article from John Bogle said to do this. So how many of us find ourselves, you get to the end of the year, and you didn't do anything that you originally planned on? Stay true to you know your money better than any of us. Stay true to your strategy. And you know what? We're all different. Personality enters into an investment strategy. It is very important. It's more than age. There's a lot of people out there who are younger people, as I said earlier, can't handle stocks. They can't handle the volatility. And then I have some clients, typically older clients, older business people, that I have to rein them back in because they want to buy more stock. You know, it goes both ways. But this is very important, to stay disciplined and just stay true to yourself. And I'm going to wrap up on that.